Today, we're looking at whether we are, in fact, near a US recession. There's a few indicators that are flashing up, but really, how close are we? We're going to find out a little bit more. Then the trading takeout today is going to be on the RSI, and it's the best RSI trading tip you'll find on the internet. But before we get into anything, make sure you like this video and subscribe to the channel to ensure I pop up in your YouTube feed every day, giving you the best market tips, commentary to maintain your trading edge. So there's one indicator that is sort of flashing massive warning signs to me at the moment that we will enter a recession in the US. And it's the spread between the US 2-year yield and the US 10-year yield, also known as the 2s 10s curve. And you can see that here. So basically, when it's below 0%, it means the curve is inverted. And we're in an inverted yield curve, essentially, which basically means that shorter term interest rates are higher than long term interest rates, which gives like a downward sloping yield curve, okay? Because obviously you've got higher rates here at the front end of the curve, and then they decrease moving further, or they're at least less than the front end of the yield curve. And that basically is showing that there's an expectation of yields remaining higher in the short term, but then they have to decrease, which can be a recessionary signal. And what a lot of people don't realize about that, though, is really the recessionary signal comes when it starts to get normal again. So when longer term rates become higher than short term rates again. And there's various reasons for this. I guess it's probably because people are pricing in higher interest rates. So they want to pull investment and things like that, higher interest rates in the mid to longer term. So they pull investment and they save it because they can get a safer return in, say, bonds, or perceive that they can get a safer return in bonds, for example. That reduces credit flow, which then means that businesses aren't, as liquid. And then you start to get cracks opening up in the market, and then obviously employment goes and stuff like that. So that's really what is the big warning sign. But if we were to throw a recession indicator here, let me just type that better. Recession indicator. Let's try this one. Hopefully that one's good. Don't like that one. Let's try a different one. Recession. Let's try this one. So these red dots are basically recession indicators, and I think they're actually based off of this 2s 10s curve and when it reverts, which is pretty interesting, to be fair. Now, you can see that every single time it's reverted, we've actually had the recession about a year or so later. So you can see in 2007 to 2008, what happens is the curve inverts. So the spread goes below zero, it goes negative, and then it reverts, and then we have the recession. So what we're looking at here is, say, if we go back to 2007, we had the recession 2007-ish, late 2007, 2008 into 2009, and then we got out of it. But it wasn't right here when the curve inverts, which is what everyone thinks is the timing of the recession. They tend to think that the recession happens when the curve is meant to be inverted. So it's quite the phenomenon that seems to just keep occurring, and we're in quite a big one here. We're actually in the biggest inversion pretty much ever. Right here at this point, and this was in 2023. So there's a considerable worry, I guess, from my perspective of how we go here. The difference is, however, is the ownership of treasuries. So here, and obviously here are different perspectives. So here, which is most recent, we had the most QE ever. The Fed owns the most of the bonds. So this changes the comparison that you can create versus the other periods of yield curve inversion. The fact the Fed does own this many, though, gives us sort of a different perspective as to how the market might be supported going forward, because they have such a high ownership already. The fact that they have that ownership means that they're more likely, rather than unlikely, to introduce QE again, to ensure that markets stay liquid. So this is probably one thing that the market is actually pricing in right now. It's that they're so far gone in terms of all global central banks that if things do start to get worse, there's going to be considerable support provided because they're so far gone. They can't revert any further. So this is one thing that we're really having to look at, is how actual stock markets behave in recessionary conditions now, because the liquidity is there, and the liquidity is what matters for markets, not the actual recession. And that's something key to understand. I think what we might see is, if we do tend to get a broad-based recession, what we might see is that markets stay flat rather than just having a steep decline, like, say, in 2007 and 2008. If we go back there and look at 07-08, here you go, there was a massive, massive decline. Here, when COVID hit, the reason we got a decline was because liquidity just left straight away. Everyone went on a hunt for dollars. There was no liquidity at all in the market. Unless we get an event similar to that, I don't necessarily see us having a broad-based decline in the same way. And even if you look at, how recessions and, market declines work, we've had a big one here. Let's just go back to that. We've had a big one here. We've had a minor one here. But are we likely to just keep repeating that? I don't know. I think it's too close to say that we're going to have another one like this in 2024. I think it might be further off. And the way that employment seems to be holding up, we're going to see over the next month or two, because there are, lots of layoffs occurring, et cetera, et cetera. The way employment seems to be holding up is quite nicely for now. So unless there's cracks and fissures that start to occur there, I don't see how there should necessarily be a broad-based effect on markets. So there's something key with the RSI that a lot of people don't tend to mention or speak about. And it's actually very similar to what I've just spoken about in today's video about the recession and about the spread differential on yields. And it's that with the RSI, you tend to find that the declines occur once there's been a crossing down, rather than necessarily the crossing up of a threshold. So if you see here, we've got the, I believe we have the 70-30 quoted for the upper and lower bounds. So there's 30 and there's 70. That tends to be the standard RSI measures, right? If it goes above 70, people tend to think it's overbought. If it goes below 30, they think it's oversold. But the actual trading signal, and this is something to always test and bear in mind, occurs once we come down. So if we were to zoom in here, the trading signal to sell perhaps would occur like that. Okay, it would occur maybe just before it crosses down. It wouldn't necessarily occur just crossing up. And the reason for that is it's just a pure momentum shift, right? And we want to be looking for momentum consistently. Naturally, in equities, the more advisable thing to do would be to look at buying that way. So it wouldn't be to look at selling necessarily on indices, purely because of the construction of an index. It's designed to go up over time. So always bear that in mind with RSI, and probably a lot of the other technical indicators, is that it's sensing a shift in momentum, but the trading signal occurs the other way, not necessarily on the initial crossover.